Most NRIs in Dubai and Singapore believe this. I pay zero tax where I live and India has a treaty, so my Indian mutual fund gains are also tax-free. This one belief can quietly cost you lakhs in taxes and penalties. Is it a myth or a fact? Let me explain in 60 seconds. What do most NRIs actually believe? The whole thing rests on two assumptions. One, I pay no tax where I live, so I pay no tax anywhere. Two, a treaty exists, so I'm exempt. Zero tax country plus a DTAA, what could India possibly take? Both assumptions are completely wrong. So, how are they wrong if the tax still comes to zero? Because the real reason has nothing to do with your zero tax country, it comes down to the nature of investment. The treaty lets India tax gains on shares, but Indian mutual fund isn't a company, it's a trust, and its units aren't shares. So, they fall out of that clause into the treaty's residual one under Article 13.5. And that clause hands the taxing right to just one country, the country where you live. Tribunals have upheld this exactly for UAE and Singapore residents, and since Dubai and Singapore don't tax these gains, the overall tax on mutual funds stands at zero. So, what's the catch and where does it actually cost you? Two places. This applies to mutual fund units only. Your direct shares and your Indian property, India still taxes on those. And it isn't automatic. The fund house still deducts TDS. You reclaim it by only filing an Indian tax return and claiming the treaty benefit by submitting TRC and Form 41. One caution statement, these are just tribunal rulings and not Supreme Court rulings. So claim this carefully with the help of your CA. So yes, it's a fact, not a myth, but only mutual fund gains and only for UAE and Singapore residents. Now you know what most NRIs don't. Comment DTAA and I'll send you a complete summary of the provisions and the rulings. And please share this with another NRI who needs to know it.